Welcome back to the Wall Street Podcast.
Great to be here.
Today we're digging into the Wall Street Journal from August 20th, 2025.
That's right. We're going to pull out the key insights for you, look at what's driving the markets and the economy based on their reporting.
Consider it your shortcut through the noise. So let's jump right in. Macro indicators first. The market seemed a bit divided.
Yeah, a mixed bag. The S&P 500 dipped 0.6%, Nasdaq slid more, about 1.5%, mostly a tech sell-off there.
But the Dow.
The Dow actually eked out a tiny gain, less than 0.1%. It suggests maybe some rotation, investors looking beyond tech perhaps.
Interesting. And amidst this, we got news on the U.S. credit rating from S&P Global.
Yes, they affirmed the U.S. ratings at AA plus A1 plus stable outlook. That AA plus is still very strong, signals high confidence in the U.S. ability to pay its debts.
And the reason for that stable outlook is pretty specific, isn't it? Tied to policy.
It is. S&P directly linked it to expected meaningful tariff revenue from the Trump administration. They think this revenue will help balance out weaker fiscal results from some recent laws.
So S&P is betting those tariffs bring in enough cash to steady the books, despite, wider worries about tariffs hitting growth.
That seems to be their calculus, yes. It's a notable justification, directly tying potential tariff income to the fiscal outlook.
Okay, moving to monetary policy. Treasury Secretary Bessent made some waves.
He certainly did, called for a half-point Fed rate cut in September. And he didn't stop there, mentioned needing foundational changes at the Fed, too.
How did the markets take that kind of direct commentary?
Predictably, it moved things. Bond yields dropped, and interestingly, small company stocks got a lift.
Suggesting the market started pricing in maybe looser policy ahead, easier borrowing costs?
Exactly. Lower yields and a boost for smaller, often more growth-sensitive companies points that way.
All right, let's shift gears to the corporate world. Some big valuation news.
Definitely. Databricks, the data analytics software firm, is closing a funding round. The reported valuation is $100 billion.
Wow, $100 billion. That's a huge jump, right? Something like 61% up.
That's the figure. It's really fueled by the whole AI boom. Shows that even if funding is tighter overall, the appetite for core AI infrastructure plays is immense.
So it's about the underlying tech, not just the applications.
Precisely. Foundational AI seems to be commanding that premium right now.
We also saw consolidation in a more traditional sector, utilities.
Yes, Northwestern Energy and Black Hills are combining. It'll form about a $7.8 billion regulated utility company. Shows M&A is still active across different industries.
And speaking of corporate action, activists are busy. Encora Holdings is putting pressure on CSX, the railroad operator.
Right, urging them to either seek a deal with a competitor or replace the CEO. They're citing a rising operating ratio.
Which basically means costs are growing faster than revenues. A sign of inefficiency.
That's the concern, yes.
Yeah.
A classic target for activists looking for operational improvements or strategic shifts.
And similar pressure in healthcare with Medtronic.
Indeed. They added 2 independent directors and are setting up new board committees focused on growth and operations. This follows Elliott Investment Management becoming a major shareholder. Activist influence is quite widespread.
Okay, let's broaden out again. Economic activity, consumer trends. Housing starts look strong in July.
They did jump, up 12.9% compared to last year, but the interesting part is where the growth came from.
Multifamily units.
Exactly. Multifamily construction surged over 27%. Single-family homes were up too, almost 8%, but builder confidence is actually still low.
Why the low confidence despite the jump in starts?
High interest rates are still biting, plus material costs are up, partly linked back to those tariffs we mentioned, so it's a bit of a mixed signal in housing.
Now this brings us to consumer behavior. Credit card spending seemed to be changing pace.
Yes, it looks like Americans are tapping the brakes on credit cards after a big run-up. For the first time in nearly 4 years, debit card spending growth is actually outpacing credit card growth.
What does that suggest about how consumers are feeling financially?
It points towards growing caution, maybe a pullback from taking on new high-interest debt. People seem more hesitant after that pandemic-era surge in credit usage.
But we also saw a jump in personal loans.
We did. Originations rose 18% in the first quarter. These are often used to consolidate credit card debt, which sounds good.
But there's a catch.
Often, yes. The data suggests many borrowers pay down their cards with the loan, but then quickly run the card balances back up. So it highlights ongoing financial pressure for many households. Debt consolidation isn't always a permanent fix.
Okay, let's try to connect some dots. Thinking about the investment landscape, private equity seems to be at a bit of a crossroads, even with rules changing to allow 401k access.
That's a good point. The big challenge for PE firms right now isn't necessarily raising money, it's selling the companies they already own and selling them at good
They
prices.
have a backlog.
A huge one. Reportedly, over 30,000 companies in their portfolios globally. It's this massive inventory they need to exit to return cash to their investors.
Yet, their fee income is still growing.
Fee-related earnings are holding up, yes. And there are some positive signs, like a hot IPO market, which could provide an exit route. It might favor the larger PE firms with more resources to navigate this, though.
So, tying this all back for you, our listener, these are just abstract numbers. Trump's tariffs, for example, could directly affect the cost of goods, maybe even materials for home renovations or construction.
Absolutely. And that shift away from credit cards towards debit, that reflects real budget management happening in households, trying to navigate higher interest rates and debt burdens.
We're even seeing shifts in unexpected places, like reports of screenwriters retraining as therapists. It underlines how economic uncertainty is forcing adaptation across many fields, not just finance. It really speaks to a need for flexibility and careful financial planning for everyone.
So think about how these trends, the policy shifts, the corporate strategies, the consumer caution might play out in your own financial life or career decisions over the next few months.
What's the biggest takeaway for you from today's deep dive?